Hi, I'm Kelly O'Connor with Financial Caffeine. Another question that I get often is, Kelly, how do I decide how much to put in or to contribute into my insurance policy? So let's dig into that today as a quick little example of what we do in order to help you figure that out. All right, so let's take a look real quick about how we structure policies for people. But the very first thing to make sure I get across is that insurance is a want product. It is not a need product. There isn't any financial person out there that could tell you how much you need to do, how much you need in literally in life insurance, and how much you need to have in cash value. So let's dig into how we uncover what's possible with you and potentially help you decide what it is you want to do. So first, we want to look at your buckets of money. And if you recall, these are our assets that are how they're taxed, right? This is our ordinary income bucket. This is our capital gains bucket. This is our tax-free bucket. And this is our tax-exempt bucket. Now, very likely, you don't have anything in the tax-exempt just yet. And here, it's only a Roth. Again, a lot of my clients don't qualify for the Roth. And of course, we have muni bonds, right? So typically, when someone steps in and we start chatting, they have a lot sitting over here, and they kind of look like this. If we consider the teeter-totter, they are the kids sitting on the teeter-totter all by themselves. They are very tax heavy on this one side, and we need to try to apply a little bit of pressure on this side. So instead of drawing a little person, let me just draw little boxes. So these assets are sitting over here like this. So what I want to do is I first want to look at your old money, as I call it. Number one, old money. Now what do I mean by that? That's money that's sitting in these here. It's capital that you already have acquired. If you remember the financial pie conversation, it's your current financial pie. It's money you've already accumulated. The second is new money. Now what do I mean by new money? New money is money that you are contributing to build these accounts, right? This is a 401k contribution. This is an IRA. If you're self-employed and you're doing 50 grand into your IRA, that's new money. How much money are you contributing into these buckets? So what I call an increasing tax plan, and that's fine if that's what you want, an increasing tax plan is taking our new money and continuing to fund these, which just keep us on this side of that teeter-totter, right? So what we look at, let's just wipe that whole thing out, are your buckets, the values, old money. Is it possible with any of these balances to systematically bring them over here? And then we want to look at the contributions that you're giving to these things. And potentially, well, let's just do this. And potentially do this too. Why? Why would we do all this? Because of this. This little concept of a teeter-totter is very simple and important to understand. You're going to have these buckets sitting here, but we want to build a bucket over here as well. Why? Well, it makes distribution a heck of a lot better. Because what if tax rates are really high later on? Well, maybe we pull from this thing. What if they're really, really low? What if it's super favorable? Well, maybe we pull more from these and we minimize this one. We just keep this thing cooking. But it always gives us the opportunity to go back or forth to ensure that you pay the least amount in taxation, that we don't means test your Social Security, if at all possible, that you have full leverage and control of the spin down as much as possible, and that you have the highest spendable income that you can attain. In many cases, I've had people just tell me, they just said, hey, Kelly, I know what my money looks like. I want to put 200 grand a year into the policy. And can you run those illustrations? Yes, of course. Let me do a little due diligence. Second, this is, I don't know if I mentioned it first, but there's a need to understand two particular strategies that we look at when we are doing this. When we determine the old and the new money, there's two ways to use these type of policies. One is a full funding of it, which can take about 7 to 10 years or longer if you choose to continue to fund it in perpetuity. And then the second is it is a short funding in order to create room for future assets. Now, I have a video of a case study, and I'm going to go through the difference of these two. So we first look at your new or your old and your new money, and then we look at the funding strategies that fit you the best. Are we trying to create room for future divestment from a future sale of real estate or a future inheritance or a future sale of a business, and we want to have a bucket to where those monies can dump in? Or are we just looking to transfer money in and create that account with current assets and current new money, current contributions? So there's two funding strategies, but that's what we do. We look at old and new money, and then we decide which funding strategy and what products fit the best to make that happen. So hopefully that makes sense. It's really quite simple. Now, again, you've got the code to utilize to get on my calendar, which saves you $500. Please take advantage of that. I do have people who hit my calendar, but I just simply can't work with. I just can't work with everybody, so I have to use that as a little buffer. But for you, because you're in, you've purchased and listened to my audio book, I want to make sure I give something of value back to you. So use that code, get on my calendar. I look forward to having the opportunity to discover what it is you can make happen here.